Welcome to The Explainer. Today, we're jumping right into how to navigate the stock market now that the Federal Reserve is finally cutting interest rates. We're going to look at which sectors could really pop and even zero in on a few specific companies that our source material has flagged. Okay, so let's get right to it. This is the question on every single investor's mind. After years of hiking rates, the Fed has officially flipped the script. But what does this pivot really mean for your portfolio?
So first things first, let's talk about the Fed's big move. We've got to unpack what this first rate cut in years actually means for the whole economy.
So how does this one single change set off such a massive chain reaction? Well, it's actually pretty simple. When the cost of borrowing money goes down, the motivation to spend and invest goes way up. And that's the economic engine we're going to follow today.
Okay, next up, let's trace what we're calling the rate cut ripple. We're going to see exactly how this one decision can fuel the entire market.
Here it is, the chain reaction in 4 simple steps. The Fed acts, right? That makes money cheaper to borrow. This pushes regular people and big companies to spend and expand their businesses. And that, in turn, pumps money and growth directly into specific parts of the market. Which brings us to the most important question, right? Which sectors are we talking about? Where exactly should you be looking to find these opportunities?
Well, our research points to these 4 key areas. They tend to be super sensitive to lower borrowing costs. For real estate, it's obvious, right? Cheaper mortgages. For consumers, think lower interest on credit cards and car loans. And for those high-growth tech and small-cap stocks, it means cheaper fuel, cheaper capital to innovate and grow.
So, let's narrow our focus from broad sectors to specific companies. The source material highlights companies with rock-solid fundamentals in these exact sectors, and they all have a strong buy quant rating. Now, that's a powerful score based on dozens of data points measuring a stock's health and momentum.
All right, let's dive into the data with 3 stocks to watch. We're going to look at 2 very different types of REITs, that's a real estate investment trust, and a really interesting global fintech company.
First up, we've got Host Hotels and Resorts, ticker HST. This is a big one, a major player with that strong buy rating. And it's sitting in a perfect sweet spot, you see, because it benefits from 2 of those key sectors we mentioned, real estate and consumer spending.
And its sheer scale, that's its superpower. By focusing on luxury hotels, the really high-end stuff, HST taps directly into the kind of travel spending that just explodes when people feel a little more confident about their finances.
And the numbers, they totally back this up. We're talking $496 million in adjusted earnings in just one recent quarter. That's a key sign of profitability. And this strong performance came before the rate cuts even took full effect. That suggests a really solid foundation with a ton of room to grow.
Okay, next, let's look at something completely different, a much smaller, way more specialized REIT called Postal Realty Trust, ticker PSTL. Notice it's a small-cap stock, another one of our key sectors, and get this, it's ranked #1 in its entire industry. So what's the secret sauce here? It's all about stability. Its main tenet is the U.S. government. They lease properties that are absolutely essential to the country's logistics. I mean, that's a level of security that's almost impossible to find anywhere else.
And the result of that stability? A near-perfect 99.8% occupancy rate. Just think about that. That incredible consistency is what lets the company pay out a super reliable dividend, which, by the way, is currently yielding over 6% for its shareholders.
And finally, let's pivot and talk about the financial tech sector. This is UP Fintech. You might know it as TIGR Brokers, ticker TIGR. It's another strong buy, but this one has a very different, very global growth story.
Now, I know what you might be thinking. A Singapore-based company, why would it care about a U.S. rate cut? And that's a great question. The answer shows you just how connected our global markets really are. A decision made in Washington, D.C. can have a huge impact on a company halfway around the world.
See, a rate cut in the world's biggest economy tends to fire up investment activity everywhere. It often kicks off what's called a risk-on environment, where investors are more willing to chase growth. And what does that mean? It means more trading volume for global platforms like TIGR Brokers.
And you can see the results right here. The company's projected revenue growth isn't just good. It's more than 4 times the average for its entire sector. That is the kind of explosive momentum that really gets Wall Street's attention.
And all that incredible momentum, which is being driven by smart investments in tech, like its own AI chatbot, and expansion into crypto, has led to this, a 217% gain in its stock price over the last year. This company is just firing on all cylinders.
So, after digging through all that, what's the big picture? What's the final takeaway when we talk about all this volatility and opportunity?
The key thing to remember is that change creates potential. A big shift in Fed policy, yeah, it brings some uncertainty, but it also reshuffles the deck, and it creates a really clear tailwind for certain industries, and for the smart companies that are well-positioned within them.
And that, my friends, is the billion-dollar question that the entire market is watching. The Fed is walking this incredibly thin tightrope between boosting growth on one side and stopping prices from spiraling out of control on the other. How they manage that balancing act? Well, that's going to be the defining economic story for all of us in the coming months.